Yes, yes.
Good evening, everyone, and welcome to day 2 of the ACCA Professional Revision Session for paper P7, Advanced Audit and Assurance, which is being conducted online and delivered across 41 countries from 31st October till 26th of November 2016. Today's session, once again, will be conducted by Mr. Abdullah Fahad from SCAN School of Accountancy, Pakistan. Abdullah is a fellow member of ACCA. He is a Director Assurance at EY Fort Roads, Pakistan, and part-time faculty member at SCAN School of Accountancy. Some housekeeping instructions for all of you. Those of you who are attending the session at Approved Learning Partner, please write down your question on a piece of paper and hand it over to the moderator at your center, who will put up the question to the tutor. However, those attending the session from home, please write your questions in the question panel on the right-hand side of your screen. The master moderator will ask the question from the tutor on your behalf. The next person speaking is Abdullah Fahad. Thank you, Abdullah, for joining us, and hope all of you enjoy the session and good luck for your exams.
Thank you.
Thanks, Fahad. We could just move to the slides. Hello, everyone. I hope we had a good day yesterday, trying to learn a lot of things. We'll do a little recap of what we've covered yesterday. And for this, we would have to move to the slides. So here you can see on the slide, we covered yesterday, after the introduction, the regulatory environment, ethics. There was a long discussion around ethics. What are the key exam techniques with regard to ethics? The Code of Ethics has 5 fundamental principles, and of course it also has the threats to independence, which we covered in a lot of detail yesterday, including question practice with regard to Code of Ethics. We covered a bit on tendering and also money laundering, which are concepts that are obviously fundamental as well. They're in the earlier areas of the syllabus, sections A and B, and of course they have been tested many times. One key technique to remember on ethics, as I said yesterday as well and would like to repeat today, is to bear in mind that you have to describe why a threat is a threat. And that is really important to get the full and try and capture the full amount of marks that are available in any ethics question. Moving on to look at the plan for the day, for the remainder of the day and today as well. Today we are supposed to cover practice management. We will have a little discussion on advertising, and also one area that is like we just discussed that a bit briefly yesterday is quality control. So we'll talk a bit about quality control as well today in the first session. Later we move on to one of the most important areas of the P7 syllabus, which is risk assessment and audit strategy. And that, as you are all aware, is usually what is tested as part of question 1, and sometimes also in question 2, and partly in section B of the paper as well. So this is something that is going to be very important. It is fundamental for you to understand what are the basic exam techniques, the good techniques with regard to practicing question 1s in the P7 paper. They usually worth a lot of marks, and if you start well this question, in fact it sets the tone for the whole paper at the end of the day. And so it's really important to get a grip on question 1. This is really the question that is going to give you a majority of the marks that can enable you to have eventually the pass versus fail decision. And we are going to have a lot of question practice in between as well. But primarily what we want is that you should be comfortable with at least one of these question 1s. And for that purpose, I have chosen the December 2015 attempt of ACCA paper P7. So we will be doing question 1 of the December 2015 session, which relates to Dali Company. Moving on in the next few days, we will be tomorrow looking at group audit situations. Today we are not covering group audits because we want to be comfortable with audit planning and strategy first before we move on to the group audits. And then there will be a quick revision of the key financial reporting standards. So for example, we will be looking at property, plant, equipment, inventory, and what are the key areas of audit with regard to, for example, financial instruments, government grants, borrowing, foreign exchange, and related parties. So this is the area we'll be covering tomorrow, and we will also slightly mention the reports and the reporting criteria. Day after that, which is 10th of November, is going to be important because it is going to discuss an important change that has come up in the International Standards on Auditing, and that is around the GAM, K-A-M, Key Audit Matters, which is a new area of the syllabus as well, and as well as a new area for the auditing profession as a whole. So we'll discuss about ISA 701, which is why I've kept that in the first half of Thursday, after which we will close all assurance-related work and move to non-assurance work, which is also an important part of the syllabus, ranging from 25 to 30, 35 marks at times. This would cover reviews, due diligence, internal audit, social, environmental, public sector, and performance information auditing, an area that has been tested frequently in the recent past, and we will do some question practice on performance and environmental auditing as well. And on Friday, we are supposed to cover prospective financial information, PFI, forensic accounting, and current issues. After which, we do the mock exam on Saturday, followed by a 2-hour debrief session on the same mock exam, which we have chosen. You will be given 3 hours to practice the whole. I totally recommend that once we've gone through all the areas of the syllabus, you actually do have this feeling of what the 3 hours feel like prior to actually going into the exam hall and having that feeling. So I strongly recommend that you practice the mock exam in the 3 hours that will be available on Saturday morning in some cases and afternoon in some other cases for you guys. And we will follow that up with a 2-hour debrief. So moving on to today's agenda for the day, which is going to revolve around practice management, risk assessment, and then audit strategy. Let's start off with practice management. The part of which we left behind from yesterday relates to advertising. Meanwhile, if there are any questions from the Code of Ethics or any other areas that we discussed yesterday, please feel free to put them down in the question box. I will be happy to take them 15 to 20 minutes from now. Okay, advertising. As you are well aware of the fact that advertising in the auditing and accounting profession is very different from the way you see advertisements in your local media, whether that is above the line or below the lines. Auditors are not allowed to advertise in the way many of the other consumer products companies are advertising these days. Advertising, with regards to that, the key features that are available, we need to look at what are the rules that are stated in the ACCA Code of Ethics. And there are particular rules with regard to advertising, what can and cannot be done. Although there is no specific guidance on what would constitute ineffective, inadequate, or inappropriate advertising and what would not. However, there are broader principles that are available that need to be followed by all professional accountants in public practice. So the key measure, as you can see on the slide in front of you, is that on advertising, the medium that should be used should not reflect adversely on the member, which is to say the ACCA member, ACCA, or the accounting profession. Now, this would obviously raise the question, what could happen that would lead to an adverse reflection on either the member, other members, ACCA, or the profession as a whole. So consider this case where let's say that I offer an audit to a company and I say that if you give me 3 audits, I give you 1 free. So basically I'm offering 4 reports in the price of 3 audit reports. Now this is basically, yes, you have seen this happening in the consumer products industry and many other industries as well. But this basically calls into question the level of competence that would be deployed to do that free audit. And we also discussed this yesterday when we were discussing Code of Ethics. So sometimes the issues related to advertising do not just have an impact on the Code of Ethics, but also have an impact on the advertising rules within the same Code of Ethics. Now, on the fees, how and what type of fees should be charged, of course, there is no prescribed basis for fee. Now, how it usually works in different organizations across the globe is that usually there is a time-based criteria that is used to calculate the proposed fee. And that usually follows a working. So, for example, we put in the hours that are going to be spent by the partner, by the manager, and by the staff. And this would also include, if it is necessary, the time expected to be spent by the tax partner, by the IT partner or other professionals, and any other professionals such as experts which the auditor may want. And usually you make up a summary of what are the key tasks that need to be performed. So those tasks are listed down here one by one, and you end up writing the number of hours that are going to be taken for completion of each of these tasks. So these are then added up to come up with the total number of hours that are likely to be spent to perform the audit. So you come up with the total number of hours and you multiply that with the rate per hour. And this will be different in different jurisdictions, of course, and this would mean that the partner hours obviously are going to be more costly than the manager and the staff hours. So you multiply that with the rate per hour to arrive at a total number of dollar or pound or rupee or whatever currency there is, value that is to be assigned to the audit. Usually this is how it is worked out. However, in some jurisdictions there are other measures that can be used as well. For example, sometimes a fixed amount has been prescribed by the national body of chartered accountants. So for example, in Pakistan we have a situation where any company that has a revenue of more than 5 billion must have at least a minimum audit fee of a certain amount. So this can also happen, and there are certain jurisdictions where the minimum audit fee has been prescribed. However, do bear in mind that that is just a minimum. And the reason for that is that there is obviously a level of risk that is being associated with any audit that you are taking. So for example, if it's a manufacturing company, that could involve the audit of inventory. And of course, the audit of inventory is likely to have some hours spent on the staff numbers, for example, to verify physically whether the inventory is present. And also, there will be some work on the part of the manager in trying to assess whether the staff's work with regard to provision for example, inventory obsolescence has been correctly calculated and is appropriate considering the size of the organization. Also important to note that on the fee, the Code of Ethics also prescribes that percentage or contingent fee is not allowed for assurance engagement. However, percentage or contingent fee can be given for a non-assurance engagement. So for example, if I am providing valuation services, then there is a possibility that I can say that I would want to charge a fee that is an X percentage of the total value that is going to be assigned. Now, obviously there is a risk in this particular situation that if I assign a higher value, that also means that I will get more revenue. So in certain situations, sometimes the non-assurance work also may have certain repercussions or restrictions with regard to what is the maximum or the minimum or the whole range of fees that can be charged. So the percentage or contingent fee is allowed, but only for non-assurance work. Then also another requirement on fee is quoting too low a fee may introduce threat to competence and due care. And we discussed in a lot of detail yesterday the concept of lowballing. So when you are actually engaged in a lowballing exercise, what you're basically doing indirectly is not probably giving an indication to the shareholders that the audit may not have been performed at the appropriate level of quality. And that is why it is not appropriate to quote this fee, and it is obviously mentioned there in the Code of Ethics as well. Fair and reasonable regarding seniority of staff, time, risk, and responsibility. And as I just showed you a few moments ago on the table that we calculated how we can calculate the fees. So it's also important that if more senior staff is required on the audit, obviously that senior staff is likely to have a higher cost. And that is expected to raise the cost, the audit fee much higher. So for example, let's say that I am going to audit a manufacturing company. Now, in a manufacturing company, which may have a similar amount of revenue, it is highly likely that there is risk associated with inventory and perhaps receivables. And these two areas are likely to be highly risky, and they would involve the time of manager, senior manager, director, or partner within the audit team, in addition to the time that would be spent by the staff to audit these numbers. However, if you compare this with some other organization which, for example, has a fixed contract and which is delivering, for example, fixed price contract, which, for example, is going to deliver to the government, and it is going to receive a similar amount, a fixed blocked amount, then obviously there is a much lesser risk in this case that a higher number of hours would be required to be spent to address that risk. So the audit fee that has to be quoted must be reflective of the amount of time that is going to be spent on the audit by each level of staff that is going to be part of the audit team. And this, as I said, also includes not just the finance team, the audit team, but also the IT team, the tax team, and any other experts that are used to perform the audit. Tendering. So based on the work that is performed, the computation that you do, you send out a tender. A firm puts together a tender if it has been approached by a prospective client or the partners have decided that they are capable of doing the work for a reasonable fee. Of course, prior to having the tender, prior to sending it out, you do your client acceptance or client continuance procedures. And this is obviously different. So one has to realize the difference between client acceptance and engagement acceptance. And this can actually turn up in a P7 question. So client acceptance may not be the same as engagement acceptance. In client acceptance, you're basically saying that you look at the track record of the client, who the major shareholders are, what is the industry in which is it operating, whether there is a high risk with regard to material misstatement, and of course the overall at the audit level if there's a high level of audit risk that is being accepted by taking on this client. No matter what kind of services you're going to provide. So the services could be review or a due diligence or an audit or some other assurance or non-assurance work. However, client acceptance procedure will be different from what you are going to do for engagement acceptance level. So there is a possibility that you get a client and you do the client acceptance, but then when you have to perform services, you may want to do more than one engagement acceptances. This can be the case, for example, where you are doing the audit work as well as the tax work for one particular client. So the client acceptance may be carried out at the first stage, whichever comes first, whether it is the audit or the tax that has been approached first. However, for the engagement acceptance, you would have to do separate procedures for whether or not you should accept this client as an audit client, and separately, whether or not you should accept this client for the tax engagement purpose. So this would be different, and the procedures that would be performed are also likely to be different, in addition to the timing difference that would be there whenever these assignments or engagements would be carried out. The auditor will also have to consider fees and practical issues, such as the availability of suitable personnel. So for example, if a client approaches me in the busy season when all my staff is busy and they really want me to do an audit of a client which is really, really tough because it has a lot of risks involved and it requires a lot of input from my senior staff members, it is likely that I would have to either say to them that we need to defer the date when this can be done or not accept the audit. And the reason for this is that there is absolutely no tolerance with regard to the quality. As we saw yesterday as well, the quality has to be maintained at the highest level. And for this purpose, if I say that, okay, I'm going to replace my well-qualified, more senior staff with staff who is less trained and less senior, that will not serve the purpose in case of a client that has a high risk. Based on all of these activities, the firm will then prepare an audit proposal. And in this proposal, amongst other things, the fees would also be mentioned, but also the credentials of the firm, that it has similar experience with regard to the same industry or similar types of other clients, and the fact that how the audit will be done, what will be the overall methodology to do the audit, and what are the key issues that you believe will take a higher amount of time. And also, communication protocols will be discussed in the audit proposal. Do bear in mind that the audit proposal has been done prior to the engagement letter being signed. And the engagement letter is obviously signed when the proposal has been accepted. So before we move on to quality control, let's do a little check on whether we have any questions coming in from yesterday. Fahad, do we have any questions? No?
No.
Seems good. Okay, so we'll move on to quality control. As we mentioned quality control yesterday, you have to bear in mind that quality control has two aspects.
It's just one question.
Oh, a question just came in. Okay.
Sadia said, can you kindly explain non-assurance services from fee perspective?
Okay. Non-assurance services is any service that an audit firm is offering to a client that is not required, in which the audit firm is not required to provide assurance. So, for example, an audit is basically designed to provide reasonable assurance. Similarly, a review is designed to provide negative or moderate assurance. However, a valuation service or a tax advice may not provide that level of assurance. So those would fall under non-assurance work. Similarly, if I am doing any consultancy or advisory work or transaction advisory work, that would also fall under non-assurance work. So any work that I am doing the audit as an audit firm, because I'm using my expertise as a chartered accountant or a chartered certified accountant, and I'm providing that expertise to the clients, whether it is for in an advisory capacity or a tax professional capacity or a law capacity or a valuation expert capacity, that would be deemed non-assurance work. And the fee for that can actually be based on a percentage of the overall amount or the underlying that has been agreed.
There's another question. Can you kindly explain the difference between objectivity and integrity and intimidation threat and advocacy threat?
Okay, so that there are two questions actually within that question. The difference between objectivity and integrity.
Yeah.
Okay, so integrity, as we discussed yesterday in the Code of Ethics, relates to being straightforward and honest, whereas objectivity relates to not allowing conflicts of interest or bias to come in. So as I gave that example yesterday as well of the company that belonged to my brother, but I was favoring that company because I thought that it's good, it's offering a good product. Despite the fact that the company may actually have been good, the decision would have been impaired. Why? Because it was my brother's company. So it could be said that I am exercising perhaps integrity, but I am not being objective in my decision making because I am offering this contract to a company that belongs to my personal family member. So integrity and objectivity are different in terms that integrity would relate to being straightforward, being honest, speaking the truth, whereas objectivity is related to not allowing conflicts of interest and not being biased on one party as compared to another party or one decision as compared to another decision. The second part of the question relates to advocacy and intimidation threat. Advocacy threat and intimidation threat are different because advocacy threat is in a situation where you are advocating a certain point of view on behalf of the client in, for example, a court of law. So, for example, it could be the case that the company is facing litigation and you are representing them in a court. And you are basically taking their point of view and explaining it to the judge that the company has a right point of view. Whereas intimidation is totally different because intimidation works in a way whereby the company actually comes up and says, either directly or indirectly, they are forcing you into circumstances that would preclude the exercise of impartial, reasonable, professional opinion. So they are basically saying that, okay, if you are going to give me a qualified opinion, I'm going to take you to court. Or if you give me a qualified opinion or whatever bad opinion that you intend to give, I will not give you the other subsidiary audits that I had intended to give you in the past. So intimidation is effectively coming from the client's end, whereas advocacy you are doing on behalf of the client, and that is becoming a threat because you are advocating at their point of view in the court.
There are a few more questions. Haris is asking that any fees that's collected from the non-audit assurance engagement, would that be classified as self-interest threat?
Fees that is collected from non-assurance work could become a self-interest threat if it is a high percentage of fees, as we discussed yesterday in the Code of Ethics. So if you are getting so much fees, so significant amount of money from the non-assurance work that you're doing, that this client becomes one of the most significant clients of your firm, and for example, it constitutes 60% of the whole revenue of the firm, then yes, that non-assurance work could become a possible threat to independence.
Osama is asking you to kindly briefly explain the difference between the client acceptance and engagement acceptance. Similarly, Fakhruddin is asking you to explain the same thing with an example.
Okay, we can do that, sure. On the client acceptance versus the engagement acceptance, the client acceptance is when there is a company that has approached you and you are going to provide certain services to them. And those services are not necessarily audit services. They could be tax services, they could be consultancy or advisory services, or they could be any other services. So what you're going to do before you accept the client is you're going to make sure that the client, its shareholders, its management has a clean track record. They do not have negative publicity, for example, in the media. They are known for their transparent practices, and there is a level of accountability within the organization. So you want to make sure that before you engage in any kind of activity, not just audit activity, but any kind of activity, with that particular client, you want to make sure that it is not going to cause you any extra risk to the firm as a whole. However, once you've accepted the client and you made the decision that, okay, this is my client now, and you start providing, for example, tax services. And now this client comes up to you and says that in addition to the tax services, I want you to do the audit as well. So now in this case, you have to perform additional engagement acceptance procedures. Why? Because you have accepted the client as a tax client. Now you are going to accept from this client, you are going to enter into another contract, which is going to relate to the audit, and that is another engagement altogether. So from an audit perspective, you will have to do certain engagement acceptance procedures. So client is at the broader level, the client acceptance, where you're saying whether this client, I should enter into a relationship with this client or not. That relationship could be any relationship within the perimeters of the chartered certified accounting firm. However, an engagement acceptance is related to what exact engagement is being offered. That could be a tax or an advisory or a valuation or an audit engagement.
The next question is, what's the difference between attestation, engagement, and direct reporting?
Yeah, so this is kind of old school as well in the way that it is usually in the introduction and regulatory chapters within the books that you may have been reading. Direct attest engagement versus the assurance engagement. What you need to bear in mind is that an audit is providing you reasonable assurance, and it is a reasonable assurance engagement. You are actually telling the shareholders that you have gone through the records, verified the records, and performed and providing them with the reasonable, which is high but not absolute level of assurance.
Arsalan is asking, can we say that non-assurance services are different than audit services?
Yes, non-assurance services will be different from audit services. Audit is an assurance service. Audit offers a reasonable level of assurance. Similarly, a review is also an assurance service because a review is offering a moderate level of assurance. Lower than audit, but still it is assurance. However, we can provide certain type of advisory services or, for example, computational services, which may not actually be providing any type of assurance, and those are the non-assurance services.
And the last question is from Asim, and he's saying, can you explain what is tipping off?
Tipping off, yes. Yeah. So we discussed that yesterday as well on the money laundering part. Tipping off is when an investigation is being carried out into suspected or alleged money laundering activities, and the inspector or somebody within the organization provides some kind of hint or indication to the person or the whoever the suspected or alleged person is who is performing that money laundering activity. So, for example, he tells this guy that we want you to ask this particular thing about you, how these finances came, because I think there appears to have been some laundering of money. And so you're asking a question in a way that the other party gets alarmed as to, okay, maybe there is some kind of investigation or questioning that is going on which I was not aware of. And then they actually fix their house, and whatever wrongdoings allegedly they were doing, they try to fix them up or cover them up. So tipping off is basically trying to give an indication or a hint to a particular person as regards an investigation that is being carried out with regard to money laundering. So we now move on back to quality control. Quality control, as I said, is related to two levels or two areas. One is the ISQC 1, which is the International Standard on Quality Control, number 1, and the other is the ISA 220, which is the International Standard on Auditing 220. So ISQC1 is basically related to the firm as a whole, and it applies to the firm as a whole, irrespective of the fact whether the firm is just providing audit services or other non-audit services. So for example, it would apply equally to taxation and to consultancy and to transaction advisory and to other services that the firm may be offering. However, ISA 220 is purely an auditing standard, and it only applies to quality within the audit ambit, and hence it relates to how better the quality should be, and it should be managed with regard to a particular audit situation. So ISQC1 will talk broadly about things such as training and development, having a CVE record, having personnel in the organization that have the right level of skill and expertise with regard to performing these services, and delivering the right level of client service and quality services. However, ISA 220 is more stringent with regard to audit particularly, and it would have requirements. So, for example, the engagement partner is responsible for ensuring that quality is maintained at the highest level, that all the risks have been addressed, documentation has been done appropriately, and the right level of quality has been achieved in the audit situation. So while there might be some overlap between ISQC1 and ISA 220, it has to be borne in mind that the ambit or the area around which these two are based are different. Now, going to the slides, quality control at the firm level, litigation against the firm could result in bad publicity, disciplinary action, and the loss of clients. And this is why quality is of paramount importance. The safeguards to prevent litigation include observing acceptance procedures. We just talked about them: engagement acceptance and client acceptance, and not accepting difficult clients. Now, what could be an example of a difficult client? Let's say that a client approaches you and they want you to perform the audit of their particular financial statements. Just while they do that and you're trying to verify and doing your client acceptance procedures, you look at some background research that has been done on that client, and you figure out that just a few days ago there was really bad publicity about the client, about their financial records, and there had been some improper bookkeeping that had been done, some allegations of fraud that had been raised, and a few persons had resigned from that company because of those allegations. What would you do in such a situation? This is typically the difficult situation that is mentioned on the slide. So this is basically a situation where you're thinking, should I or should I not go for this audit? And there can be many cases where you could be involved in these situations. For example, another one could be having a situation where you have PEPs, politically exposed persons. Now, PEPs, or politically exposed persons, are people who perhaps are active politically within the national jurisdiction of that country or that state. And these people are obviously highly likely to have a lot of media spotlight on them, and they're usually always in the limelight. So any alleged wrongdoing or irregularity that may come up could lead to a huge risk, not just to their reputation and image, but also to the person who is providing audit services, for example, to the companies that are engaging with the politically exposed persons. So it is important to understand sometimes that there are certain difficult situations or difficult clients that you may have to thoroughly review prior to accepting your engagement. Then there is instituting client care procedures. So you make sure that you know about the client. We talked about KYC yesterday, know your client or know your customer. So it's really important that you understand who exactly your client is. Then there is the concept of key man insurance, and which is also covered in the concept of professional liability, which we did yesterday. So you could have professional indemnity insurance or fidelity guarantee insurance. Now the difference between the two needs to be understood as well. Professional indemnity insurance and fidelity guarantee insurance. So for example, professional indemnity insurance is when some person within the organization did something wrong, and that resulted in you giving an inappropriate opinion on the financial statements and you being put into litigation from the client's side. So the insurance company comes and it provides you with cover on this. And then the fidelity guarantee insurance is whether your own employee had done that particular activity. It could be a fraudulent activity or irregularity, and you are safeguarding yourself against against that particular damages or loss that you may suffer. And then obviously it also talks about setting up a system of quality control. So it is important to understand that ISQC 1 actually relates to the whole firm, and which is why it talks a lot about how a system of quality control should be put into place. So it will talk about things such as having the right staff, providing the right training, for example on CPE, having the right policies and procedures, and effective risk management practices. Risk management. So these are the key themes around which ISQC 1 is based, and these are what ISQC 1 is usually talking about. And it also goes on to talk about leadership responsibilities. So the overall responsibility for ensuring that the audit is done properly, all the tax services are carried out in the right way, the tax laws have been taken into account. So it also talks about leadership responsibilities. And this you can see on the slide is ISQC 1. The objective of the firm is to establish and maintain a system of quality control to provide it with reasonable assurance that the firm and its personnel comply with professional standards and applicable legal and regulatory requirements, and reports issued by the firm or engagement partners are appropriate in the circumstances. Plus the fact that the entire business strategy of the firm should be driven by the need for quality. And this is really important. So what ISQC 1 is trying to achieve is it's trying to inculcate a culture of quality within the firm. So whether you're providing a valuation service or a tax service or an advisory service, consulting for example, or transaction advisory, or it is an audit service, the basic premise behind ISQC 1 is to inculcate a culture of quality and consultation within the firm. So as we talked about leadership responsibilities, and you can see this on the slide in front of you, is that the firm may appoint an individual or group of individuals to oversee quality in the firm. Such individuals must have sufficient and appropriate experience, the ability to carry out the job, and the necessary authority to carry out the job. So it's also important that you do not place low-level staff or junior staff in charge of the quality department of the firm. Usually you would know from your experiences, if you have with the audit firms, that these big firms usually have quality department or risk management department, or they call them sometimes QRM department, the quality risk management department, or they could be worded similarly. However, the job that they do is usually similar, and that is to actually make sure that overall the quality, the culture of quality is maintained within the organization. There is a proper client acceptance and continuous process. Staff is being trained regularly. Good quality staff is being hired on a regular basis. The positive experiences are being given to the staff, whether it's audit or tax or whatever. And the policies and procedures are not just there, but also implemented actually. So it is important with regard to these particular areas that usually there is a separate person or a department. However, it is slightly different in the case of smaller firms. In smaller firms, you would not see whole full-fledged departments that are working solely on quality and risk management. Sometimes they just assign one person who is doing this job, and that one person is making sure that the audits are being carried out following the standards, the ISAs, the tax work has been done looking at the national tax laws and the changes that happened. Clients are being accepted after having a rigorous client acceptance procedure and KYC. And those are the kind of things that this person is carrying out. So the way that this is being applied, the ISQC 1, in different jurisdictions from bigger country to smaller country can vary a lot. And similarly, it will also vary from the bigger firm to the smaller firm. So in bigger firms, you would see whole departments that are working on this, and in the smaller firms, they may just be one person who is looking at all of these things. Quality control also talks about HR, the human resources of the staff. As I said, in a firm of chartered certified accountants, the biggest resource is neither building nor land nor furniture. The biggest resource that they have is the off-balance sheet resource, which is the HR, the human resource. So the staff that is working are basically the biggest assets of the firm. and making sure that the staff are appropriately trained, they have the right types of experiences, hands-on experiences, as well as classroom-based or web-based learnings, as they call them, experiences. They are there, they have the right amount of training and expertise and skills that are needed to carry out the job effectively. So this would involve recruitment, for example, capabilities and competence, career development, compensation and estimation of personnel needs, so compensating them appropriately as regards to the work that they are doing, the services that they are providing, performance evaluation and promotion. Again, the quality control at the firm level relates to assignment of engagement teams, which is the responsibility of the engagement partners, who should be sent to which clients, what types of the experiences are required to be built. That is also important to understand. And then ensuring that good engagement performance involves direction, supervision, review, consultation, and resolution of disputes. There can be many cases actually, and this is an important one that needs to be understood. So I think that it's important that we highlight this as well. The review and consultation mechanism that you can see over here, and the dispute resolution. So these are two important areas that need to be looked at, because there can be cases where there are differences of opinion with regard to the following key policies. For example, there is a risk that has been taken out, and the work that has been done to address that risk may not be deemed as sufficient for one partner, and it may be deemed sufficient by the other partner. So is there a culture of consultation within the firm? That is also encouraged by ISQC 1. And then there is a dispute resolution mechanism. So for example, there is a dispute within the audit team, and that dispute could relate to disagreement on an accounting policy, for example, disagreement on the type of tax advice that is going to be offered, or a disagreement on the value that needs to be assigned in evaluation engagement. And in these cases, it's important that there is a process of dispute resolution within the firm. Firms must also monitor their state system of quality control and have standards on what constitutes a suitable quality control review. Now, on the monitoring part of the ISQC 1, the quality control procedures must be relevant, adequate, operating effectively, and compliant with. So we talked about policies, that the policies should be there. Now, what you see over here on the screen is that policies should also be implemented. So they should also be operating effectively. Now, corrective action could include remedial action with the individual. So, for example, if it's one individual who's involved in, let's say, quality not being at the right level, or communicating with training department to perhaps provide the right types of training experiences to this individual or group of individuals. Changes in quality control policies and procedures may be required, and disciplinary action if necessary. And this would include reprimanding them, penalizing them, or reporting them to the authorities, depending on the severity of the action that has been done. Now we move on to IEC 220, which also talks about quality, but as I said that it relates to quality control at the individual audit level. So it will be important here to point out again the difference between the two. ISQC 1 is at the firm level, and IEC 220 is at the individual audit level. So this would relate to one audit, and this would relate to one firm as a whole. So now we are moving to IEC 220. Now this also starts from where ISQC 1 left off, and that is basically the leadership responsibilities. So we talked about leadership responsibilities on ISQC 1, and this is where exactly 220 starts off by saying that the responsibility for making sure that a quality audit has been carried out, and now we are just talking audit and not the other services. So making sure that the effective audit quality is maintained is the responsibility of the audit engagement partner. Now, who is the engagement partner? The engagement partner is the person who is signing the audit opinion. So he is taking the overall responsibility for the conduct of the audit in accordance with the applicable auditing standards, and he is the person signing the audit report. Now, there could be other partners who are also involved. For example, there could be a tax partner or an IT partner or even another audit department partner engaged in the same audit. However, it is the engagement partner or the person who is signing the audit report who is given the overall charge and responsibility for making sure that the requirements of IEC 220 have been met. Adhering to professional requirements, including independence and objectivity. Now, these are, as you see, two additional principles that apply in the case of audit. So, in case of a tax assignment or, for example, agreed upon procedures that are being carried out, it may not be really necessary to remain independent. But in case of an audit, of course, it is the responsibility of the engagement partner to make sure that everybody on the audit scene is independent. And usually a term that is used in the big firms as well for this particular case is covered person. So covered person is any person who is actually engaged in serving the client, who's giving face time to the client, who's serving the client, and he's performing the audit service. So if he's part of the audit team, he's a covered person and he needs to be independent of the audit client. Acceptance and continuance of audits, the decisions should be made with regard to particular care should be taken with regard to the facts and circumstances. Sometimes this could be the case that you have an audit that you've been doing for a number of years, 3-4 years maybe, and all of a sudden something happens in that client that alarms you or rings your alarm bells and says that we need to be aware of the fact that and we need to consider whether we should continue to do this audit or not. For example, sometimes it is taken over by a competitor, and that competitor is really not well known with regard to its financial reporting practices in the media, for instance. Or you are well aware of the fact that that competitor just recently had a qualified opinion issued by one of the other audit firms. Appropriately qualified and experienced staff should be hired. This is also a key message that is transferred from ISQC 1 to ISA 220. So because you have the right level of staff that you had and you provided them the right training opportunities, and this was for all the staff. So when this translates into ISA 220, what it basically says is that make sure that on an audit, the staff that you are deputing to conduct the audit or to do the audit field work is adequately experienced and they have the right amount of skills to carry out the job. So for example, if you're auditing a bank, so you will not be sending out as an audit senior or the audit executive a person who has no exposure to the financial sector. And somebody who's just done the manufacturing or services sector may not be well aware of what are the key issues associated with the audit of a bank, for example. And lastly, there should be monitoring procedures with regard to quality control. So whenever the audit engagement has been done, there should also be a procedure. And this is basically where the EQR concept also comes in. This is the concept that has been introduced by ISA 220, EQR. This is known as the Engagement Quality Review. In some jurisdictions and some in the unofficial language, it is also known as the Independent Review or the Independent Partner Review. However, the term that has been used in ISA 220 is the EQR, Engagement Quality Review. Engagement Quality Reviewer is usually another partner who is not involved in doing this audit. So, for example, if there's a firm that has 5 partners and 3 of those 5 partners are engaged in audit services, so there is one partner who's signing the audit report for that client, but then there's another partner who has his own portfolio of clients and he is looking at those clients and not involved in this client. So, however, before signing the report for the client, this partner number 1 is going to go to partner number 2 and say that, can you be the EQR on this audit client that I just am about to sign the report for? So what the EQR does is that he is an independent person. He has, well, probably not met the client even, does not even know them, but he knows the business and what the key issues are. So what he does is that he goes into the shoes of the audit engagement partner and says that if I were in your place, after having reviewed the entire audit file and the work that you've done, your strategy, your risk assessments, and based on all of that, the conclusions that you reached based on the work that you've done, I totally agree with the opinion that you are about to give. So that is also where the concept of hot review and cold review comes in. So the hot review, which is carried out before the audit report is signed, and cold review, which is done after the audit report has been signed. So any questions with regard to quality control, do feel free to put them in the comment box, because we will now be moving on to a more important area of the syllabus, which is with regard to risk assessment and audit strategy and planning.
Sadia is saying she's slightly confused that from a question perspective, when should a person be responding with respect to ISA 220 and ISQC 1?
Yes, sometimes it can be really tricky as to what the question is about. Usually you have to make sure if it is talking about the question scenario is talking at the broader level and it's giving you a scenario where it says that the firm has been approached by client X who want to engage you for various services. Now this is something usually that should trigger ISQC 1 first and ISA 220 later. So if the perspective is broader and there is a client or a person who's approached you and they want to provide certain services, but they're not specifying what kind of services, or they're not just talking about only audit services, then probably this question relates to ISQC 1. Sometimes, however, it happens that, and this has happened in the past, that there's a part of a question that actually relates to audit. And it is only the audit quality that has been mentioned within that. So it would be worthwhile to focus your answer only on ISA 220 and not mention a lot ISQC 1 in detail. And the reason for that is obviously that on an audit, individual audit level, if you're talking about quality, the standard that you need to refer to would always be ISA 220.
Stefan is asking, EQR is an acronym now.
Okay, EQR, if you just missed out, is Engagement Quality Review. And the person who's carrying out this review is known as the Engagement Quality Reviewer. So it is applicable to the audit engagement quality review or engagement quality reviewer. The independent person who was not involved in the audit activity is basically going through your file and looking at the risk assessment and the audit plan that you made and the work that you did. And he is giving his own impartial opinion, his own independent opinion as to whether he agrees or disagrees with the opinion that is being given by the audit engagement partner.
Musab is asking, is it mandatory to have an EQR?
Okay, is it mandatory to have an EQR? No, not as per the standards. However, there are certain trigger points that can actually act as situations where an EQR should be conducted. So for example, if it is a bank or an insurance or a highly regulated industry, if it is a public interest entity or a listed audit client. So those are cases where usually the risk is much higher as compared to a private business. And in this case, it is recommended that an EQR should be carried out. As per the standard, an EQR should be carried out for all listed entities and public interest entities. However, EQR can be triggered by circumstances such as a higher risk coming into the audit, and it is a small company, a small family-owned business maybe, but the risk is too high with regard to, for example, the valuation of inventory. And in that particular case, there is a possibility that an EQR may be sought.
Saad is asking that the quality control reviewers will review the quality of the work performed by the engagement partner. Is that correct?
Not just the engagement partner, the whole team. Because the engagement partner is like the captain of the ship. So he's the leader of the ship. But actually, there's this whole team that is working under him. So he's reviewing the entire work that has been carried out. But that does not necessarily mean that he's reviewing each and every working paper. So he's looking at the broader aspects. So for example, usually I can put it in this way that if the audit engagement partner has spent about 100 hours on the audit, the EQR may probably be spending about 10 to 15 hours at maximum to review the whole file and to make a judgment as to whether the opinion that is being given is appropriate or not. That's because the partner and the team that has worked with the partner has actually spent a whole amount of time and they've documented everything in the file. So the EQR is only going through what has been documented in the file. And he's basing his decision on the documentation that he's reviewing. So it's usually much lesser time that is spent. And the EQR is not just reviewing the work of the partner, he's reviewing the whole audit file, the work of the entire audit team.
Hassan is asking, in an exam question on litigation avoidance, can we add having indemnity and fidelity issuance, with other quality control procedures as litigation avoidance?
Yes, definitely. Litigation avoidance can be managed in a way. You cannot avoid litigation that's because if somebody has put you through a suit, a legal suit, and you have been called by the court of law, of course you have to go. But the damages claim that may come up or the amount that you may have to pay eventually if you are found guilty of negligence or whatever, professional duty being breached, then in that case, yes, professional indemnity insurance could work. And there is also in the case of litigation avoidance the concept of the structure of the partnership firms that are working. So that is not on the slides, but I will just quickly try to cover that up so that we are sure of the litigation avoidance. what are the techniques that could be used. So one is the firm structure. So there is usually, the firm follows a structure of a partnership. And this is how usually the firms have been operating for a long time in the world. However, there is this new concept of LLP, where some people may say that it's not new anymore, but there are still many countries that do not have this concept. The limited liability partnership. So actually what happens is that the way that the profits are distributed within the firm is done just like it is done in a partnership. However, the liability of the partners is limited to a certain amount. Now that amount would be fixed at a certain dollar value or a local currency equivalent, or that amount would be fixed as basis of the capital that has been built into the partners account. There is also the concept of incorporation. So the audit firms are now also thinking about, and in many countries they have actually converted into companies. So if this becomes a company, then what happens is that there are no partners and there is no partnership. Actually, there are shareholders. But what happens in this case is that the company must have shareholders and the company must have its accounts prepared. Sometimes the national law may have restrictions with regard to what it can and cannot do, the kind of work that can be done, and also the fact that they may have to submit their financial statements and get them audited by somebody else. So this could also happen. So those could be the potential demerits or disadvantages or the downside with regard to company incorporation for a firm. But these are also cases where the discussion around what is good and what is bad could be done.
There's a question from Asif. He says that adherence to the ethical requirement is relevant in quality control. So why is it important to be seen as an independent individual, and what effect would it have on our firm as a result of this impairment?
At an individual level, of course, it is important that we understand that being ACCA members, we are subject to the ACCA Code of Ethics, and we have to follow the Code of Ethics. However, when you enter into an organization, which is, let's say, an audit firm will have its own rules. So if you are to breach those rules, one, you are not being compliant with the contract that you signed with that firm, but secondly, there is also possibility, for example, if there's some wrongdoing or irregularity or financial irregularity that has been done, that you are not being compliant with the general principles of the ACCA Code of Ethics. So it is important to understand that sometimes, doing something that is potentially unlawful or illegal would not just have civil law consequences, but also consequences on disciplinary action that is being taken by the Chartered Certified Accounting Body or the Chartered Accounting Body of which you are a member.
Okay, there's one final question that's from Hassan, and he's saying, what are the things or aspects that a firm should include in the tender?
What are the things that a firm should include in tender? Okay, I'll just repeat that. We talked about it in a bit detail a few minutes ago. One is, of course, the audit fee that we talked about, the graph or the table that I made. The other is the key responsibilities, what the scope of the work is going to be. Sometimes you have huge groups that need to be audited, so it is good to mention that we understand that it is 1, 2, 3, 4, 5. These are the companies that we need to audit. What is going to be the scope of the work, if there are any timelines. So it's not as detailed or as, and of course also the credentials that you have, we talked about that as well earlier. So it is not, of course, important that you mention each and everything into this, because the proposal is not a contract. At the end of the day, after the proposal has been accepted, it is the engagement letter that is going to be the contract. So you have to make sure that whatever needs to be explained to your potential client is explained by way of putting it down in the audit proposal or the tender. However, once you get into the acceptance phase and you're moving ahead or after the acceptance phase, that is where the contract signing comes in, and that is where the engagement letter comes in. So you put in all those clauses in there as well. So proposal basically acts to serve as a reminder of what you understand are the requirements, and based on that what the fee is and why you are eligible to get this particular engagement, and what are your credentials on that. All right, so we are now going to move to risk and audit strategy section. As we talked about earlier in the first session as well, question 1 within section A is very challenging, not easy, has been a source of discontent and headache to many candidates that I have been facilitating for P7 in the past. However, do bear in mind that this is not the kind of question that you can just get away with by, just not by practicing it at all, or just by reading through the book. This is where the actual application part of the syllabus requirement actually comes in. So when, it's mentioned in the ACCA paper P7 guides and the examiners' resources that are available on the ACCA global website, that this paper requires not just knowledge but application of knowledge. I believe that the most impactful, can be seen in the question 1. And the reason for this is that this is usually revolving around 1.5 or 2 pages of text and numbers that is written in the question. There is a whole lot to read, a whole lot to understand, and then there is an email usually or a briefing notes that you have to prepare and give a response to. Now, this is something usually candidates may not find comfortable being comfortable with, and the reason for this is sometimes they are just overloaded with the amount of information that is given in the question. But the fact of the matter is, it's not going away. It has to remain there. It is a part of the paper P7. So you have to, number one, accept it, that it is going to be there, and you have to take it head on. So take the bull by the horns, as I said yesterday, and I'm saying that again today. So be energetic about it, be enthusiastic about it. Yes, sometimes it can be a daunting task, the question 1. However, be geared up and be fully prepared to answer this question. And we'll talk a lot about the exam techniques and what are the good practices that we should have. So before we, we talk about the theory, which I'm not going to take a lot of time on, the reason for that is that it's more important to work on the actual question practice and how you should approach the question, rather than just talk about theory, about the methodologies and what is materiality and what are the risks and what is the definition of this, which perhaps many of you already are aware of because you've gone through the F8 paper as well already. So we'll talk a bit about exam techniques as well. So moving on from risk and strategy, the key standards that are applicable here are the most important one, is ISA 315. But then there are other standards that come into play with regard to audit risk and strategy. So for example, you should be aware of ISA 320, which relates to materiality. We'll talk about that. Then there is on the going concern, ISA 570. Sometimes there are entities in question 1 that are facing going concern issues or financial difficulties. In some cases, the response to risk has also been asked, so ISA 330 also comes into play. Sometimes it is the documentation that has been questioned about, so it is ISA 230 that comes into play. We also talked yesterday about fraud, so ISA 240 with regard to fraud, and we also talked about ISA 250 on laws and regulations. So these 2 standards also come into play. As I said yesterday that they are not going to go back, they are not going to die, we're going to talk about them, so we are, and we're also going to talk about them tomorrow when we do group audits. So these are the key standards that usually are examined, but then there are a whole lot of other accounting areas that are tested as well as part of question 1, which is why, as we discussed yesterday, that the P7 examiner expects that you have a good working knowledge of P2, paper P2, corporate financial reporting, and you are well aware of what the key accounting standards are, the financial reporting standards, and especially the ones that have changed in the recent past or have been part of current issues in the last 3-4 years. So related to those, you could see that related parties are also relevant. The related party standard is ISA 550, and of course, when I mention ISA 315, it's also important to mention the fact that it is not just theory or English language that is written in there. There is a lot of numbers that are usually in question 1. And whenever the examiner is giving you numbers, what does he or she really want? They really want you to pick up the calculator and do some calculations. In other words, they want you to do an analysis. And that's where ISA 520 comes into. So ISA 520, analytical review, also comes into play. So as a whole, you can see that we are basically discussing all of these standards whenever we are looking at many of the questions that revolve around audit strategy and audit planning. Primarily, our focus is going to be ISA 315 and to some extent ISA 520. However, we will touch on the areas of materiality, ISA 320, going concern, ISA 570, IC 330, response to the risk or responding to the risk. IC 230, documentation. There have been areas in question 1 where sometimes they have tested that the previous audit senior left and the new audit senior came in, or the manager came in, and the file is in a really bad shape and the planning has not been carried out appropriately. So what would be done about this situation? So documentation. IC 240, fraud. IC 250, laws and regulations, and IC 550, related parties. So some of these areas we're going to cover, and then we're going to move on towards the question practice and talk about the techniques. Now, the basic premise on which IC 315 is based, the objective, as you can see on the slide in front of you, is that IC 315 says that the auditor should obtain an understanding of whether the entity has a process for identifying business risk relevant to financial reporting objectives and deciding about actions to address those risks. So there are key concepts about business risk, and there is some theory behind that as well, and you would see that here. Just if I could move to the slide. The business risk, which has 3 components: the financial risk, compliance risk, and operational risk. So of course these are risks that you would be well aware of. Business risk is the risk arising to a business because it is in operation, because it is there. So for example, if I am in the business of selling juices, I could be faced with a lot of risks. One is that the fruit that I have, that I'm using and I'm processing or squeezing to get the juice, the fruit has a very short shelf life. The fruit cannot last very long. So I need to store it, or I need to use it rapidly and then pack it. Then I need to sort out my problems with regard to my vendors, for the suppliers who are giving me all the raw material, the fruit. Then I also need to make sure that the factory is in the right condition and I have the right idle time built in, the order time built in, and I receive the orders on time, process that and make juice and pack that juice and sell it in the market. So there is no point in time that my juice is off the shelves in the market. It's always available to the customers whenever they want it. And this would actually classify as either financial or compliance or operational risk. So as you can see on the slide, financial risk, which is a part of business risk, is the risk arising from the financial activities or financial consequences of an operation. Compliance risk, which is also a part of business risk, is the risk that arises from non-compliance with laws and regulations. And we talked about IC 240 right here. And then operational risk is risk that is with regard to the operation of the entities. For example, what if my plant and machinery just stopped working? What if I faced a sudden shutdown of my plant and machinery? How would I carry out my operations? For example, what if there is a trade union and the staff, they all go on strike and they say that we're not going to work in this factory because our demands have not been met? So those kind of risks would be operational risks. And some of that may overlap with certain compliance issues and, of course, financial issues as well. So business risk is being faced by the business because it is a business, because it is over there, it is operating in a certain environment, it has a supply chain, it has suppliers or vendors, it has service providers, it has employees, there is a government that is on top, and tax authorities, and then there are, of course, more important customers to whom you are serving. So that is something that is important to understand with regard to the basic requirement of risk and IC 315. Now, there can be different audit approaches that can be taken with regard to managing the risk that is faced by the auditor. However, not all business risk will actually translate into an audit risks. So looking at this particular picture, it is important to understand how business risk can emanate into or transfer into an audit risk. So we just talked about business risk, and this has, of course, the components of operational risk, financial risk, and compliance risks. So these are like bubbles or balloons or whatever you want to call them, which are part of this big business risk equation. From the business risk is going to emanate an audit risk. And that audit risk could arise because, of course, you know the audit risk equation. AR is equal to risk of material misstatement multiplied by detection risk. And this particular ROM, as I said, the risk of material statement, is made up of two things, IR and CR, inherent risk and control risk. And you can see this not just on the camera, but also on one of the slides over here. As you can see, AR, audit risk, is the risk of material misstatement multiplied by detection risk. So ROM, or the risk of material misstatement, is inherent risk multiplied by control risk. Just a quick recap on what these risks are. Inherent risk, you can see on the screen, is affecting the client as a whole. Relates to management integrity, for example, nature, IT being complex in the organization, industry factors sometimes, and pressures. And it is for this reason that it is important to understand through the use of an example. Now there is a question, and I would like to have a response in the question text box that we have. Let's say that you're talking about a risk, and there are two companies that you're talking about. One is the company Ferrari, and everybody knows that they manufacture cars, Ferrari, which are luxurious cars. And the other is a company, that is ABC company, that manufactures nuts and bolts. So compare ABC nuts and bolts with Ferrari. Let's assume that on the statement of financial position, both of these companies carry inventory. And the value of inventory is in both cases $10 million. So the inventory of Ferrari in the statement of financial position of Ferrari is $10 million. And the inventory of ABC nuts and bolts in the statement of financial position of that company is also $10 million. You're talking about the same account, the inventory account. Where and why do you see high inherent risk? Just think about it for a moment. Where and why is more important to respond. Do you see higher inherent risk? You can put in your responses in the question box, in the text box.
Asif is saying Ferrari because they have high value.
Ferrari because they have higher value. No, they don't have high value because the total value is still the same. It's $10 million for the Ferrari and $10 million for ABC nuts and bolts.
Shazeen is saying ABC because it's difficult to count the inventory.
Okay.
Yeah.
It is difficult to count the inventory of nuts and bolts. You've got nuts and bolts, small pieces, lots of them, perhaps spread all over different warehouses and stored in godowns. Whereas Ferrari is likely to be lesser. Other responses?
Ali is saying it's a higher risk in Ferrari because of its high value.
Mm-hmm.
Nakash is saying ABC and company because it may be difficult to put a value on the nuts.
Mm-hmm.
Nuts and bolt as compared to cars. Shafiq is saying Ferrari because of impairment, change in the model or technology. That
Okay.
could be one of the reasons.
Good, that's interesting, the responses that we have received. But what we need to make sure is that we're talking about the finished goods inventory. So how difficult would it be to audit this $10 million sitting on the statement of financial position of Ferrari? Perhaps it would be a few cars that you just go into the godown and count 1, 2, 3, 4, 5 and you're done. But talk about verification of ABC nuts and bolts and making sure that it's easier to account for this $10 million. This is not going to be in one small location. This is going to be spread out. This is really small value items. So if we talk about inherent risk, which is risk by nature, irrespective of what are the controls, irrespective of what the auditor could do, just by nature, which is difficult. It is ABC nuts and bolts. And this is the concept of inherent risks. So sometimes it is just the nature of business or the nature of work that is being done by a business that leads to higher inherent risk. And nothing has been done actually. Let's look at another example. Barclays Bank has in its statement of financial position advances. These are loans that have been given to various companies. And obviously whenever you give a loan to a company, you do that against a security. So they have given you a certain security deposit, and based on that you are charging them LIBOR or LIBOR plus certain percentage, and you have given these loans advances to various people across the country. And compare this with another company, which is, let's say, ABC Telecom. And they also have an asset in their statement of financial position, and that asset is basically the license that they have obtained from the government. So you have two assets. Both the assets have same value, $10 million here and $10 million here. Barclays Bank asset of $10 million is advances, loans that they have given to various people based on their risk profiles. Some of those are small loans, some of them are large loans, some of them are not recoverable, some of them are non-performing, some of them are paying money on time, some are not. And then there is another asset of same value of $10 million, which is appearing in the statement of financial position of ABC Telecom. And this is basically a license that has been acquired from the government. Because if they want to operate within the telecom sector, they must obtain a license from the government. And the reason for this is, so they pay that money, and whenever this company will be shut down, this money is going to go back into the company, and it's going to belong to the shareholders. So there is not going to be absolutely zero change in the value of this until, of course, there is an impairment, a significant impairment, that is, or the company is going to wind up. Where do you see high inherent risk? Think about it for a moment and put your responses. Where is the high IR?
Muzamil is saying Barclays because it's difficult to trace payments.
Barclays because it's difficult to trace payments.
Yeah. Hassan is saying Barclays Bank as there is a high chance of bad debts.
Okay.
Yeah. Zamir is saying Barclays because it's more risky. Kessler is saying Barclays due to the exposure to credit risk.
Mm-hmm.
Yeah.
And one last response.
And Essen once again is saying Barclays because of the quantum of customers.
Great. So this seems to be an easier question as compared to the previous one. And yes, the correct response is Barclays Bank. Why? Because it involves much more risk. There is no fault of Barclays Bank. The only fault is that they are a bank. But that's no fault. It's by nature. So inherent risk is risk by nature. Just because of the fact that they are doing this kind of business, they are doing this kind of work, there is a higher risk within this $10 million as compared to this $10 million. And this is the concept of inherent risk, which you need to understand. Now, not all inherent risks would actually become really significant risks. So what is examined in the P7 paper is actually not the concept of inherent risk solely. Rather, what is usually asked is what is a significant risk. So for inherent risk to be classified as a significant risk, obviously it has to be a high inherent risk. And for this purpose, for an inherent risk to convert into a significant risk, it must be higher up on the matrix of impact and likelihood. So we talk about this matrix, then you may have seen this in your textbooks as well and in your notes. On the one side you put impact, and on the other side you put livelihood. Now, not all risks would fall into this category. It is only the risks that are falling in this category, high impact and high likelihood. It is these risks that would be classified as your significant risks. So for example, for Barclays Bank, there is a high impact if many of the customers do not pay the loans back on time, or they do not have the security that they provided, does not have the right value to cover the exposure that has been taken. And the likelihood of that is likely to be higher because there is a large number of people, the economy could be in recession, and there's probably many companies or organizations and individuals who are not going to pay the money. However, in the case of ABC Telecom, the likelihood that the license of $10 million will not be paid by the government is much lower. The impact may be there or here, anywhere, but it is still an inherent risk, but not a significant risk. Similarly, going back to the Ferrari example, there's a high chance that the ABC nuts and bolts would fall into this category. So you have Barclays and you have ABC nuts and bolts falling into this category. But Ferrari would not be there. And the reason for that is that the impact and the likelihood matrix would probably place Ferrari maybe somewhere here or there or here, but not in the significant risk category. So inherent risk, as you can see on the slide, is affecting client as a whole, management integrity, nature, IT, industry factors, and protections. It affects individual balances, for example, complex accounts. Some accounts by their nature are complex, and we just talked about that. Assets at risk and staff. Now I'll talk about the next component of risk on readiness statement, which is the control risk. Control risk could be high or low depending on how good the controls are operating in the organization. So control risk, it has to be borne in mind. There could be many different types of categorizations of control. One is that you try to understand what is the nature of the control. The nature of the control could be that the control is manual, or it is automated, or it is IT dependent, manual. Then there could be the other category of the control classification, which is the classification by function. A control could be preventive or detective. Now let's look at these categories. An example of a manual control. The storekeeper places certain items that have been received in the godown or the store, and he books them in the register, makes an entry that this item has been received today, and updates the quantity held in the store. The store supervisor looks at that particular paper that has been prepared and manually signs the document and closes the quantity that today's closing quantity is X. This is an example of a manual control which has been done. Another example, I prepare a check and present it to the CFO, and I'm working below the CFO, and the CFO looks at the invoice, what is the payment being made for, which is the party, are we doing it correctly, is the amount properly done, calculated, has the tax been calculated appropriately, right payment, right time, and signs. Again, an example of a manual control. Now, an example of an automated control. The weighted average of inventory is being calculated by the system itself. So every time I do a purchase, the weighted average is calculated automatically by the system. Another example of a control. There are built-in controls that do not allow that you post a debit of 10 and you post a credit of 12, and you go and press the post button, but the post button does not press. It's grayed out. And the reason is that you have a debit of 10 and a credit of 12 and does not balance. And hence the system is automatically not allowing you to put in this kind of entry that is going to unbalance the trial balance. And then the third category, which is the IT dependent manual. This is a control that is dependent on an IT system. So you're generating some report from the IT system, but then you're using that to perform or exercise a control which is manual in nature. An example of this could be that I generate an automated age analysis of all my receivables. And any receivables who are greater than 90 days, I send them a reminder that, sir or madam, please pay the money because it's been 90 days since we've invoiced you or sent the goods and we have not received the money from you. So now this is a control that is dependent on IT. Why? Because this report that I generated, the age analysis of my receivables, was generated by the system. The system was telling me how old is each receivable. But the control that I exercised based on this report was a manual control because I generated a reminder letter, signed that letter and sent it to the party telling them that you need to pay me money because you've not paid for 90 days. So this is an example of an IT-dependent manual control. Now we talk about the purpose of the control. The purpose of the control could either be preventive control or detective control. So the control could either prevent a misstatement from happening, or after the misstatement has happened, it could detect the misstatement. Now these could be different areas. So for example, you have metal detectors when you enter into a building. And the simple purpose for that is that if you're carrying any metal item and you're entering into an airport, for example, or into an aeroplane prior to embarking on a flight, then it's going to detect whether anything is metal you carry with yourself. Similarly, a prevent control is a control that is not going to let you do the misstatement. So it's probably built into the system. So you could have a preventive automated control, which I just talked about, the debit of 10 and the credit of 12. Now this was on the one hand an automated control, but also a prevent control. Why? Because it was not allowing the entry to be passed. And hence the debit of 10 and the credit of 12 would not be posted into the system. So those are the control types by purpose or by function that their control is operating. Now based on this assessment, you look at the nature of controls, you can see on the slide, look at the attitude to controls, whether the overall control environment is operating effectively or not. Now controls would obviously operate at two levels. One is the entity level. And the other is the transaction level. So the control at the entity level is working around the concept within ISA 315 with regard to what is the tone at the top, the control environment, the overall control activities, the segregation of duties within the functions, monitoring of controls, entity's own risk assessment process, and the information systems that are available within the entity. So those are the controls at the entity level, and they operate at the broader level. An example of this could be, for example, the audit committee. The fact that there is an audit committee in an organization is a control. But having that audit committee will not only be good for my inventory management, it would be good for the whole organization. Hence, having an audit committee of the board of directors supervising the activities and monitoring the control activities within our organization would be classified as part of my entity level control because it is operating at the entity level. Similarly, having a budget. A budget would of course also be a control at the entity level. But then let's talk about the controls at the transaction level. Any purchase order must be prepared, cannot be prepared without a purchase requisition. So you cannot actually order before you actually have a requisition within the organization and before you call quotations from at least 3 suppliers. So in this case, this control is acting to prevent misstatements within the purchase function. But it is no relationship with, for example, payroll or depreciation of fixed assets or borrowings or lending that has been done by the organization. So there are certain controls that are going to apply at the entity level, at the whole broader entity level, and there will be certain controls that will only apply at the transaction level. So you have to have an assessment when you talk about controls at all the three different categories. One is by type, whether they are a manual control or an automated control or an IT-dependent manual control. Second is by purpose, whether the control is there because it has to prevent a misstatement or detect a misstatement after it has happened. And the level at which it operates, whether the control is an entity level control or a transaction level control. Now going back to the equation, we talked about audit risk being wrong, risk or material misstatement, which is IR into CR, multiplied by the third component, which is detection risk. Detection risk is, of course, the risk that the auditor's procedures or the auditor will not be able to detect a misstatement in the financial statements. Now, when we talk about AR, it must be bear into mind that AR consists of two components that are fixed and the auditor cannot do anything about them, and one component that is not fixed. So, looking at this equation, AR is IR into CR into DR. Think of IR into CR, or what we also call as raw or financial statement risk, as a block of concrete, a block of bricks. You cannot do anything about it. There is nothing that you can do about it. If you are auditing Barclays Bank and it has a high risk, you as an auditor cannot tell them, stop giving loans and start making Ferraris. You can't do that. The reason for this is it is inherent in the nature of the business. So they're doing it. You accepted this audit. So you can't do anything about inherent risk. Similarly, you can't do anything about control risk, because as an auditor, if an entity has good or bad controls, well, you could perhaps recommend them in the form of a management letter later on, but you could not do anything about the period that has lapsed with those controls. So you have to accept them as they are. So if IR into CR is on the higher side, which basically means that the auditor is facing high audit risk, he will have to reduce this audit risk by bringing detection risk down. And to bring detection risk down, now comes the concept of materiality. The auditor will have to lower the materiality level. Because whenever the auditor is going to lower materiality level, it is going to lower my detection risk. And the reason for this is that when I have a low materiality level, I select more transactions. I tend to select more higher sample sizes. I test more of the transactions. And when I do more testing, that automatically reduces my detection risk. And this reduction in detection risk brings about the reduction in the audit risk to an acceptable level. So, bear in mind that AR is wrong into DR, or inherent risk into control risk multiplied with detection risk. And you cannot do anything about inherent risk and control risk. They are like a block of concrete which you cannot do anything about. So if you are faced with risks, you have to talk about detection risk and what needs to be done about this. Now, how is it examined in the question? Usually it will not be examined in the way theoretically it has been explained in the last 10 minutes. And the reason for this is that, as I said, it is always going to be a long scenario, 1.5, 2 pages perhaps, which you are supposed to go through. And then there's also some financial information which you have to analyze, and you have to come up with risks that are occurring in the scenario. Now, what could those risks be? The risks could be cash flow issues. Sometimes the entity is having problems in managing its working capital or short-term cash. Risk could be overtrading. Capital issues. Going concern issues, we talked about IC 570. Breakdown of accounting system, the system is not working. Credit risk, something that has been asked frequently. Loss of key suppliers or customers, and loss of key employees. So those could be some of the key risks that you could be faced with in question 1. But then you could also be faced with a lot of financial reporting issues. And on those financial reporting issues, what are the ones that are most commonly tested? Usually, it is IS2 for inventories, IS 16, 36, 38 with regards to property, plant and equipment, intangible assets on 38 and impairment of 36. Then IAS 37, provisions and contingent liabilities. There can be cases, and there have been in the past, of litigation being discussed in question 1. So non-compliance with laws and regulations, some chemical being manufactured or some breach being done of some environmental law, resulting in potential liability, sometimes warranty claim as well. Then we have the other areas coming in from IFRS 2, share-based payments. This has been tested. Of course, revenue has always been an area. So previously what was IAS 18, but is now IFRS 15. Is also a key area of testing. So these are the standards, at least about which you should be more than confident with regard to your grip on the basic requirements or the fundamental requirements of these financial reporting standards. We'll cover some of these in a very quick detail tomorrow when we do go towards the procedures and execution reporting part of the audit. However, it is assumed that you have a significant amount of knowledge, or at least the fundamental concepts with regard to these financial reporting issues. Right? And also, it does not mean that these are the only financial reporting standards that can be tested. So, for example, there have been areas in the past where the P7 paper has had questions with regard to construction contracts, financial accounting, derivatives, financial instruments, and similarly government grants as well. So those are the areas also which have been tested. So it is not an inclusive or exclusive kind of list that tells you what is going to be tested and anything outside is not. You should be fully prepared for anything coming into from financial reporting knowledge could be tested in your P7 exam. So now we move to the exam technique towards solving these questions. Usually you have a situation where the client is facing a certain problem, you have to describe the risk, and the question is, what are the key risks? This is what the key question is about. Now, what needs to be understood is, for number 1, the question requirement. Sometimes question 1 is going to ask you about financial statement risk. And when it says that, it basically means what could go wrong in the financial statement. So it is the risk of material misstatement. Sometimes the question is going to ask you for audit risks. And in that particular situation, you need to answer based on wrong plus detection risk. Because you will have to mention that what are the key issues in the audit that need to be discussed. Thirdly, sometimes they are going to ask you about business risks. There was a small patch of time where business risks were not being examined, but now in the recent past we've seen that there has been a reappearance of business risk questions in section A, question 1. So be prepared for any of these type of risks to be questioned. So the first thing that you need to know whenever you do the question on question 1 is what has been asked. If the requirement is focused around business risk, do not tell them financial statement risks or risk of material misstatement. Do not say that inventory is inherently risky because it is made up of nuts and bolts. If they talk about financial statement risk or risk of material misstatement, do not say that there is a risk that company may lose its customers and the competitor may take away the customers. Because of that, the company may have to suffer a decline in the revenue or profit. Unless it is so serious that it causes a going concern issue, of course. So it is important to understand what has been asked in the question. The second and more important step, once you've understood what is the requirement from you, the second and more important step is answering in detail. So describe risk in detail. Now what does this mean? This does not mean that you start talking about what is the basic requirement of IAS 38 with regard to intangible assets, and you start reproducing everything that you covered from your P2 knowledge, and you put that down into your paper for P7. No. What it usually means is that you're trying to explain what could potentially go wrong if this risk is considered. So the key question that you are answering, that you are trying to write down, is what could go wrong? What could go wrong? So you have to see that in this particular scenario, what is it that could go wrong? Where could I see that there is a potential problem? And it is for this purpose that it is paramount that you consider what is known as the so what test. The so what test is basically a test of whether you've written the risk appropriately or not. So if you are looking at the risk and you're reading it and you read it out and then say, so what? You don't get the risk. So this basically means that you are unable to explain to a layman what the risk actually is. What usually happens in a risk is a chain scenario. So one leads to another. So for example, there is a trigger, and trigger number one, and that is that there is recession in the economy. This leads to trigger number two, which is that customers are not paying because they do not have sufficient purchasing power. This triggers number three, which is that the customers of the company may not pay the company on time. This is combined with the fact that the company sells most of its products on credit and it does not have a lot of cash sales. This leads to number five, which is that a significant amount of the customers of the company are impacted by this recession. This leads to problems in recovery for those customers, which leads to number seven, the need to make a provision in the statement of financial position for any amounts that will not be recovered, which leads to the risk that this provision would be understated, which leads to an audit risk, which is number 9, that the provision for doubtful debts may be understated. Now this, as we just discussed, is a very important step in creating or producing a risk. What is the common pitfall? What is the common problem with many of the candidates is that they assume that if they have written a statement, the entire chain of events is understood. It is not. You will have to explain step by step what each of the circumstances would eventually lead to. So you start with one, the economy being in recession. And how the economy being in recession, which is, well, potentially a business risk, leads to the audit risk at number 9 of the provision for doubtful debts being understated. So it is really important to understand the so what test. The so what test is as if you're telling a layman and he or she reads that particular text that you've written and does not say so what. So it is important to understand that each risk has to be described in sufficient depth and clarity so as to ensure that how the risk has arisen has been properly explained. So when we talk about what could go wrong, we are basically talking about what could lead to the next situation. And then that could lead to the next situation. And then that would lead to the next situation. And so on and so forth until you reach the level of the financial statement account which you want to talk about. And it's very important to understand how we need to do this. So we are going to do an exercise right now. And based on that exercise, we'll have a look at how good or bad can you be when you're trying to describe risks. So for this purpose, I would like to request you to go into the handout section of the screen in front of you, and from within the handouts there is a PDF document that is titled Suggested Response. If you could also open that here, so participants, I would also see
The suggested response.
Yes. So just go to this PDF document. It will also show up shortly in front of the screen. It is a PDF document. And just wait till everybody has opened this up, and then I will give some instructions. Zoom it a bit. This is the first part. That's what we want to see. Just this part. Yeah, this is good enough.
That's it.
Yeah, that's it. Okay, so you can see this on the screen in front of you. Now, on the top, in bold, you can see an answer given by a P7 student. So this student believes that there is a company that has a certain problem because there is inventory in that company, and the company is selling through a lot of channels which are spread over across the country. Appears to be the country is South Africa. Well, okay. And since the company is selling through many channels within South Africa, and a lot of countries, a lot of places, lots of retail shops, so the student believes that it is a significant risk. And the student has described the significant risk for 3 marks. Note, for 3 marks, the student has described the significant risk as follows. I'm reading the bold text. The company sells through many channels all over South Africa. So there is a risk that employees do fraud in sales and it is not found. So the financial statements may be materially misstated. Now, consider this response and consider that you are reading this response. How many marks would you want to give to this student out of 3? Do you believe that the risk has been sufficiently described? Do you believe that the entire chain of events, as I said, from 1 to 2 and 2 to 3 and 3 to 4 and 4 to until the significant risk has been triggered, has been described, or the audit risk? Do you think that a layman who would read this would actually understand what the risk actually is? Do you even think that the risk is describing whether the risk is a financial statement risk, or an audit risk, or a business risk? The answer is most probably going to be no. So what could be a better way to answer the same? A better way is what is given on this document right underneath. Since the company's operations are geographically spread out, there remains an inherent risk on completeness of revenue, since timely, complete, and accurate information about sales from each depot may not be available at the head office, where such information is consolidated. Further, a wide geographical spread also leads to inherent limitations in the overall control environment, since information at depots is not submitted in real time online. This raises the risk over occurrence assertion of the company's revenue. Note the use of assertions, the technical expression that has been used, which enables any reader with a basic financial knowledge to actually grasp what the risk is, which account is impacted, and which assertion of that particular account has been impacted. This is what I mean when I say that you describe the whole chain of events leading to the risk, so that any person who reaches this stage and reads the risk actually finds out what is the risk, rather than just like what you read on the board, that the person reads the text and then says, scratches their head and says, so what? Because they don't understand what the risk actually is. So this is something that is very important to understand. In question 1, whenever you describe a risk, you must describe it in sufficient detail and depth and clarity. So you go to the account level and the assertion level and you describe which account and which assertion is impacted and how is it impacted. Also, on the same document, if you just go below, and I am also going there so you can see this on the screen as well in front of you. Do not assume that the examiner automatically understands what you wanted to say by writing statements such as the ones that I have given. There are 3 more examples that I have given, but I have not given the better examples for them. It's just the bad examples that you see. Cases where out of the 3, a candidate expects, yeah, I wrote the whole risk and I understood and I really think that the examiner is going to give me 3 out of 3. The problem is that you are thinking that the examiner is thinking what you are thinking, but she doesn't know or he doesn't know. So you cannot assume that whatever came in your mind will be read by the examiner. You will have to put pen to paper. You will have to write down the whole thought process behind this. You will have to describe this. Now this is very different from writing lengthy or long discussions. And I am not saying that. Many of the examiner's reports have actually commented that it is not the length of the risk description. It is actually the precision with it, the risk description with which has been described, that is important. So you must bear in mind that you describe a risk in sufficient detail and depth, but clarity and precision is really important. So do not start off by writing one whole page or half a page to try and describe a risk, but rather focus on whether you are being precise and concise as well. Now look at those examples. What is wrong here? In the first example, trade receivables are rising, so there is a risk that provision may be understated since receivables may not be paid on time. There is absolutely an assumption on the part of the candidate that because receivables are rising, so there is a risk that they not pay you on time and the provision is probably incorrect. Well, that could be a risk, but shouldn't it be more important to link the increase in trade receivables with the increase in revenue? So perhaps it would have been better had this candidate stated that trade receivables increased by 40%, whereas revenue only increased by 2%. And that is basically demonstrating that a lot of the revenue that you earned is not actually converting into cash. The receivable parties are not paying you, or not paying you at all, or not paying you on time. And that leads to the risk that the provision is understated. So, as I said here, do not assume that the examiner understands what came in your mind. You will have to put that down on the piece of paper. So nothing is understood, nothing is assumed as far as the piece of paper is concerned. What is written on the piece of paper is what you will be rewarded for. You will not be rewarded for what came in your mind but never went on to the paper. So do take cognizance of that. Let's look at the second one. Since company is offering a warranty on its electronics products, there is risk it is not recording provision for warranty. Now there could have been a much better way of explaining this. Yes, it's an electronics-based company, which is a good fact that has been pointed out by the candidate. But how does just selling electronics on a warranty actually result in not having or having a provision? Is there a need for a provision? Number one, has there been instances in the past? You could have described that in further detail. But apparently, the candidate is assuming that since it's electronics and warranty is offered, so there should be a provision. Third and lastly, due to recession in country, customers may not pay the company on time because of financial constraints. The auditor should check whether receivables are overstated. Now again, I mentioned the word check yesterday, a word that I personally do not like a lot. And of course, even from an examination perspective, I would not advise you to use it. But other than just this little problem over there are also other problems. So for example, the candidate has assumed that because there is a recession in the country, the customers will not pay on time. Not all customers are going to be like that, number one. Number two, is the industry in which we are operating actually going to be hit by this recession? Because there are certain products, the demand for which remains the same, whether there is a recession or there is no recession. For example, the demand for flour and wheat and rice, basic items that are used for the living room, eating. So, sometimes the connections need to be made, the clarity has to be there to make sure that the risk that has been described in sufficient detail. I hope that this would help you understand what the basic requirement is with regard to this particular area. Now, some more points on exam technique as you can see on the slide. As you are reading through the question scenario, it's really important to look for what are known as risk triggers. Now, what is a risk trigger? You're reading a scenario, there's a whole lot of English that's written on it, 4 or 5 lines, and right there on line number 5, you stop and say, okay, this company is in milk production. That basically means that milk is a perishable commodity. And that basically should ring my alarm bells that there is a risk with regard to inventory, obsolescence. So those are risk triggers. So what do you do with these risk triggers? If you have a pen in front of you and you're reading this, so what you do is you just underline that particular point or highlight that. And that basically helps and keeps prompting you throughout the duration of question 1, and it tells you that this is something that you had highlighted and you need to write a paragraph on this, which is going to be a risk, and it's going to give you 3 marks or 2 marks. So always look for risk triggers as you read the question. Second, prepare an answer plan. We talked about this yesterday. How important is it to have an answer plan? Should we or should we not have an answer plan? I always encourage candidates to have an answer plan. And the reason for that is that failing to plan is planning to fail. You have been asked a question that is worth 18 or 20 or 22 marks. And you need to be aware of what are you going to write as a content in that answer. How are you going to structure that answer? So it's really important to understand that particular point. And which is why we're going to talk about having an answer plan. Now, what should an answer plan look like? An answer plan should be just those triggers that we talked about. Just your thought triggers. An answer plan does not have to be a whole paragraph. An answer plan can simply be 7 or 8 bullets. These are just the prompts, the triggers, the prompts that are going to keep pushing you to, let's say that you've written a whole paragraph on this one and a whole paragraph on this one. And you do not have to read through the whole scenario again to basically find out the third risk. You've already written that down and it just triggers you and you go on writing smoothly about it. So you don't have to, in the nick of time, look at these things that, oh, I forgot about, I just had 3 risks in my answer, I had to write 7. So to find out the other 4, I need to read the question again. Don't do that. save your time. Structure your answer. Always give a structured answer, a professional answer. Important points first, less important points later. Always prioritize. Always have a plan. And the plan, if you do it well, is going to show in the structure. Give sufficient weightage to each risk. I talked about this yesterday as well when we were talking about ethics. So if each risk has 2 marks and it is an 18-mark question, you are supposed to come up with 9 risks. And 9 risks are going to give you 18 marks. Now to get these 18 marks, you need to have your 9 risks ready. If you describe the first 4 risks in a lot of detail, but then the other risks in simple one-liners, you could expect 2 for each of these. And that may give you, let's say if there are 3 of these, 6 marks. But you may only be able to capture either half or 1 for this. And this basically would mean perhaps less than 50%, which is not a good situation to have. So give equal weightage or sufficient weightage to each risk that you write. Professional written expression. Always write professionally. Do not use words such as check that we mentioned. Do not use words that are looking like what could be termed as childish or unofficial. Use language that is usually used in the office environment. Use professional language. After all, it is an email that you're writing to your partner or the audit partner or your boss, the audit manager or senior manager. Or it could be briefing notes that you're giving to him so that he could take them to the meeting with the client. So it is important to understand. Format to be used has to be as required in the question. You have to see what is the format in which I'm supposed to respond. Sometimes they ask you to write an email back to them. Sometimes it is a briefing note. Sometimes it has to be just a list of points, which is very rare in P7. So just give the format which has been asked for. Do not assume things that they have been asked from you and you assume on your own and then start giving the answer. Whatever is written, you have to come up with an answer from within the scenario that has been given to you. You cannot assume things outside of the scenario, leading to answers that could perhaps be irrelevant at times and lead to loss of time, if not loss of marks. And lastly, as we mentioned, apply the so what test. So this is an important one that you need to consider. Before we move to some exam practice, there is just a little revision of the concept of related parties that I would like to carry out before we move on to the exam practice. Related parties. A standard that is usually examined in B7 and more so in question 1 as compared to question 2 or the section B, other questions. And the reason for this is, of course, that in the practical auditing world, we get to see many times related parties coming up and transactions with related parties. Do note that, as I explained yesterday, that as per ISA 240, a related party transaction would lead to a fraud risk only if the related party transaction is significant and outside the normal course of business. So not every related party transaction is a fraud trigger per se. Some of them may be. However, you need to see which of the related party transactions are outside the normal course of business. Now, the requirements with regard to ISA 550 on related parties. Auditors, as you can see on the screen, shall inquire of management regarding the identity of the entities related parties, nature of the entities related party relationships, and the transactions with the related parties during the period, and if so, their type and purpose. So what type of transactions have been carried out with the related parties, and what is the type and purpose of the transactions. And fourthly, controls to identify, account for, and disclose related party relationships and transactions. Controls over authorization and approval of significant related party transactions and transactions outside the normal course of business. This is something that the auditor should be inquiring the management of. Now, what are the issues when related party transactions or the subject of related party is put into the P7 paper? The key issues that can be tested usually revolve around inherent difficulties of detection, because a party may not be deemed to be a related party. However, it may actually be a related party as per the definition of IAS 24, related parties. So sometimes the situation in the P7 exam could be that there is a common director, and that director is influential over there in the other company as well as here, and leads to a related party relationship, which, well, the entity over here which you are auditing has not actually accounted for. Transactions not necessarily charged for or not processed. For example, that there are transactions that have taken place, but no invoices have been raised for them. Not even necessarily evident to management, as I said earlier. Chance of concealment by the management. This is also a dangerous situation actually, where the management actually knows that this is a related party transaction, but it has not been disclosed as a related party transaction. And fourth and lastly, complex corporate structures. For example, the master feeder fund structure that we have in many of the economies where hedge funds are operating. For example, a structure whereby an SPV has been created, a special purpose vehicle, and the accounting for that is obviously complex, but then actually accounting for that and disclosing it as a related party transaction is also complex and a point of concern for the auditor. The responsibility of management to identify related parties, of course, as per the ISA, it is the responsibility, and also it is our responsibility as auditors to inquire from them what are the key related parties, the changes in the related party transactions and relationships, the key related transactions that have undertaken during the year. Materiality concept with regard to related party is judged in relation to related parties, not the entity. So you are going to judge this in relation to the party, the counterparty, and not yourself. What could be the sources of evidence with regard to related parties? Minutes of meetings of those charged with governance. That is key, because you could have board members or audit committee members who have approved the related party transactions. Sometimes some of those related parties are the ones where those audit committee or board members are actually also shareholders or owners or directors of that entity, those entities. Secondly, analytical review of transactions. So you analyze the transactions. For example, that you prepare a graph with related parties and you see that it is going fine, but then almost in 1 month it goes high and then comes back down like this. So you may want to know that if this is the month of July, so what happened here? Why did the related party transactions reach so high a level? What was the main transaction that undertook? Or maybe it will say that this is the area where a loan was taken by the related party or given to them. And that definitely is outside the normal course of business and would be treated as such. And obviously the procedures that you perform around this type of transaction would be very different. Confirmation of loans, for example, I just talked about that, so you obtain the loans. The written representations, well, the weakest form of evidence, but yes, an important form. And correspondence with solicitors, lawyers or solicitors for any correspondence with regard to related parties or significant events that are taking place. This is not an exhaustive list. This is just a small list of some of the evidence and procedures that you could adopt. But any situation that comes up in the P7 exam, you will have to apply your mind to come up with what could be the potential sources of evidence and what are the types of procedures that you need to perform with regard to related parties. Before we move on, we would like to see if there are any questions.
There are no questions.
No questions, I think. So we are ready and geared up for some question practice. Excellent. So before we do that, I just have this screen in front of you that we just discussed in a lot of detail. Just look at this once more before we move to question practice. You are going to look at risk triggers as you read. You're going to try and prepare an answer plan. Please try and structure your answer. You're not going to solve the whole question, yes, but you're going to at least, your answer points have to be structured. Prioritize the points. Professional written expression, what could you write? Think about these areas. and applying the so what test. So with that, let's move to the question. I have selected the December 2015 attempt, question number 1. It is available in the handouts. So you go to the question, and for this particular question, you have a reading time of 15 minutes. 15 minutes is what you're going to spend reading. And then I'm going to call time, after which I will give you 5 minutes to come up with an answer plan. Let's make that 7, okay? 7 minutes to make an answer plan. So let's see how much we can grasp in the 15 minutes. I'm going to time you for this. How much can we grasp in the 15 minutes? Do not start writing the answer or the answer plan. You just have to grasp what the question is about, what the major requirements of part A, B, C. And then I'll call time, and then I'll give you 7 minutes to prepare an answer plan. And we'll see that how effectively using these 22 minutes can actually help you write a response in a very little amount of time and give you good marks. So your time is going to start 15 minutes. It starts right now.
Alright people, I hope that you have read the questions. Now you've got around 7 minutes to work on the answer.
Alright guys, time is up to have an answer plan ready and also to read the question. We are going to do a little debrief now on December 15, question 1. This was a challenging question divided into 2 broad parts, but then had 4 basic requirements. A1 was worth 18 marks, which was the main one over here, which asks you to evaluate the audit risks to be considered in planning the audit of target company. There was another 5-mark question on recommending the additional information which would be relevant in the evaluation of audit risk. This is again a question, in the recent past we have seen these type of questions about additional information. And many times candidates or potential students come up to me and say that what is really that needs to be mentioned in this particular area. We'll talk about that in a bit. And then there were 2 4-mark questions, each of them were 4 marks, which was for valuation of work in progress and the recognition and measurement of the government grant. And of course, we did not cover a summary of the accounting financial reporting standards, but obviously it is expected of you to have known the basic requirements of IAS 2 and IAS 20 on government grants. Your position in the organization is that of an audit manager. So it is also important to note whenever you are attempting these questions that who are you in this question. So you are an audit manager, and who has written this email? This is coming from the audit engagement partner. So you're going to respond to this email in your capacity as a manager, and you're going to write this email to the partner. Now on the 18 marks, were you able to read the whole question and understand the basic requirements within the 15 minutes that were available to you? That's a key question you ask. Then, how did you plan your 7 minutes? Did you make an answer plan? Did you write the key points that you would have written in your answer? Do you think that by just having a look like this on the key plan, the answer plan that you have made, would that act as a good trigger point for you to prepare an answer, actually? And how long do you now think it would take for you to write the answer? The reason for this is that, as I said, failing to plan is planning to fail. So since you have a plan that has already been put down into paper, all you need to do is execute this plan. Consider this as a situation where, you have to find the way in a puzzle. If you are let alone and you are supposed to find your way in a puzzle, you will go here and there and look at all the ways and try to figure out how you can get out of it. However, if you are given a map, and that map in this case is the answer plan. If you're given a map, and then all you have to do is just follow the map and you are out of the maze. So you have to make sure that you prepare an effective, efficient answer plan, not too detailed, just the thought triggers, that will help you write a good answer. So, for part A now, which was worth 80 marks, it is also important to go and look at the marking scheme. So may I please request you to turn to page 23, where you will be able to see the marking scheme. It should look like something like this, page number 23. And I'll also try to put that up on the screen. You should have that in your handout section. Is it already down?
Yeah.
It's there. Okay. And if you just go to page number 23 in this document, you will be able to go to the audit risks that have been taken out. This much is fine. So, you can see now, evaluation of audit risk requires up to 2 marks for each audit risk evaluated and 1 mark for relevant calculations, for example, materiality and trends. Now, how do you get the 2 marks? And when we were talking about the so what test, so if you mention the stock exchange listing, which was supposed to be done for Tali company, which they were planning to do, and that would create a pressure on the results and eventually a fraud risk factor, that would count as a risk. Disclosure for listed companies, foreign exchange transactions and potential derivatives, for which there is another extra mark available, so up to 3 marks are available. Payment in advance and revenue recognition, potential for cancelled contracts and implication for valuation of WIP, new directors, many of you would have caught this point, cash settled share-based payment scheme, revaluation of property, deferred tax recognition, government grant recognition, inventory valuation, provision in respect of returned goods, and working capital. Now, why I read all of this and why is it important? There are 2 things that you need to bear in mind with regard to your answer. Your answer to any question, and more importantly to question 1 in B7, should the examiner be looking for 2 things. 1 is quantity, and the other is quality. It's very much like audit evidence. So in audit evidence, the 2 words that are usually used is that audit evidence has to be 1, sufficient, and 2, appropriate. Same applies to your answer. Your answer should be sufficient and 2, appropriate. So to first figure out whether the answer plan that you made actually picked up all the relevant points from this marking scheme that is available, it's important to note how many of these points did you actually pick up. And that is going to tell you about the quantity. So you measure the sufficiency by quantity. How many did you actually pick up? And if you did not, what was the reason for that? Did you overlook it? Did you not underline it? Did you read too fast? Were you too eager to go to the next paragraph or to the next section? Or were you just overwhelmed by the amount of information that had been put into the question? There could be many reasons, but everybody must try and do the root cause analysis themselves. What caused the sufficiency or the lack thereof with regard to quantity of points that you had? Now, how does this measure work? How do you know that you gave a sufficient or an answer that had the total quantity? You go to the marking scheme. The marking scheme is basically giving you an indication of the number of points that can be made to get the marks that are available. So to get the 18 marks for part A, you could have come up with 9 out of the points that are available. And there is a long list of these points. So there's more than 18 actually that is available. But why does it say the marking scheme up to 2 marks? It says because of the reason that you could have come up with more than 9 risks. But the marks maximum that you would get per risk would be 2, and hence the maximum would be limited to 18, barring the 3 marks that are available on the derivatives point. Next step in your answer is then to consider the quality. That okay, out of the 9, maybe you came up with 6 out of 9. But is this enough to pass? Maybe, maybe not. And for this you have to move to the next step, which is the quality of your answer. Whether your answer is appropriate given the points that you have already taken out. And for this purpose, it's important to read the ACCA suggested solution or answer. So for each of the points that you made, you think about what you would have written had you been in an actual exam situation in the exam hall. And how has the same point been described in the ACCA suggested solution of the answer? So for example, we will take one of this and we look at an example. Let's say that there is a point with regard to stock exchange listing and the pressure that it is creating on results. So let's turn our attention to question number 1, the answer to question 1, and let's turn to page 11. Page 11 of the answer. And you can see here is the response to the stock exchange listing and the pressure on results. And I'll just read a bit of this because we're not going to go into a lot of details. So how has this point been described? How will you get the 2 marks for the stock exchange listing point? The listing obtained during the year can create inherent risk at the financial statement level because management may feel under pressure to achieve good results in this financial year. We talked about risks at the broader level, risks at the transaction level. We talked about controls at the entity level and controls at the transaction level. And you see the same terminology being applied here. The flotation raised equity capital, so there will be new shareholders who will want to see strong performance in the expectation of a dividend payout. In addition, the introduction of cash settled share-based payment plan motivates management to produce financial statements which show a favorable performance and position, which is likely to lead to an increase in the company's share price. Note that no allegatory language has been used. It is very important to mention here, when you are describing a risk, you're talking about what could go wrong. And this could, the C for could is very important. So do not use allegatory language in the answer saying that the management will do the fraud, or the management has committed the fraud, or the management is increasing the share price or inflating the revenue. Rather, always talk in terms of risk. What could happen? What could go wrong? As you can see here, the expression that has been used in the ACCA suggested solution is the introduction of cash settled share-based payment motivates management to produce financial statements which show a favorable position. It can act as a motivator. It may motivate the management to do it. It's not saying that the management is actually going to do that. And that's exactly how practically, in the practical auditing world, it works. You don't say that management is committing A or B or C crime per se. Rather, you're saying what could motivate the management to do that. So it is important now to look at what could go wrong in the text that has been used.
Fahad just made a comment that he says, don't you think that the paragraph that we're discussing right now, that's too long for just 2 marks?
Yes, that is a good comment, and I think that many students, whenever they see the ACCA suggested solution, are faced with this thing that this, if I have to write in the exam hall, is a daunting task. Well, I will not say that this is exactly what you should try to achieve, but I will also not say that no, you will find if you just write 1/2 or maybe 1/3 of this. No, it's not about how long you're writing. The thing is that have you used the words that describe the risk in sufficient detail and clarity? And the same sentences that you are looking at on the screen and in front of you on the answers could be described in shorter versions, in shorter sentences, when you actually start writing them down using a pen. So I would say that this should be the benchmark. This should be the maximum level that you should try your best to achieve. However, not having achieved this will not mean that you're not going to pass. You should try your best. This is the ACCA suggested solution. This is what ACCA suggests is the best answer. So some of the best candidates, probably getting very high marks, would probably have an answer something like this. You should try your best to be as close to this as possible. However, looking at the fact that some people obviously have a natural problem that they could be slower in writing, they may not be able to explain it in this way. Their natural expression in the English language or business English that they're using may not be as fluent as you see it over here. However, you should try your best to be as close to this as possible. So we look at this answer now, and we look at now the examiner comment. So let's turn our attention to the examiner comment, especially on the audit risk question. So I would like you guys to go to the examiner comment, as you can see. So the examiner's report now, I'm going to read from question 1. This is the December 2015 examiner's report. This question followed the pattern of previous examinations, and was set at the planning stage of the audit and assurance cycle, and it covered risks, audit procedures, and other information required. Candidates were required to provide an analysis of audit risk for a manufacturer of bespoke and generic machines. Performance on this requirement was good, with the majority of candidates correctly describing audit risks rather than distances. See, that was one of the key things that I talked about. That read the question requirement first and make sure that the question that has been asked is the one that you're going to attempt. Do not assume yourself that this XYZ thing has been asked for you. Rather, you should actually make an effort to find out what has actually been asked in the question. Moving on. This is an area that most candidates are well prepared on. However, stronger answers were able to develop and apply the relevant accounting treatment. Now underline this. Something that's very important. This part, as you can see, is something that you need to look on. What were the good candidates doing? So the good candidates were able to develop and apply the relevant accounting treatment. Those able to identify specific areas of the financial statements which would be affected, and to correctly identify whether the risk was over or understatement, tended to score the strongest marks. So sometimes what happens is that candidates go and write about in their answers that XYZ thing could lead to misstatement of significant account. Sometimes the examiner is actually looking for whether you mentioned overstatement or understatement, and not just misstatement. So the stronger candidates, the better candidates, and people who would have got passed this paper with flying colors, as they would say, would have done exactly the thing that has been mentioned in the examiner's report. And then a significant minority of candidates thought that the client was new to the firm as opposed to simply having a change of manager, and spent time addressing opening balances and new client procedures which were not relevant to the question. Again, a key problem with some of the candidates, they get detracked. So they're going, they're reading the question and they're figuring out, but something just comes into their mind, it pops into their mind, and they start thinking on the other way around. And rather than going straight, they just take a detour and go to the other way, which is exactly what the examiner did not want. So you have to be careful of what is the exam requirement. The requirement in this question was audit risk. So that is what exactly should have been mentioned, and not about manager changes, opening balances, or, for example, the client acceptance procedures that we talked about earlier. Candidates are again reminded to read the question carefully and consider the context of the scenario, both in terms of client history and time frame, before answering the question. Now, if we move further to the next page, candidates were further required to provide additional information needed to effectively plan the audit, and candidates showed a marked improvement over previous sittings where this requirement has been examined. Now, this requirement of A2 is something that has been coming up now in the recent past, as I said, and it's basically trying to think about whatever has been given in the scenario in order to have a good risk assessment and in order to prepare an effective audit strategy, what additional information related to this scenario do I need? Now, this can be tricky. Reason for this is, sometimes you believe that, okay, this is the information about inventory and I'm going to talk about this, but then what about receivables? And there is no mention of receivables in the whole question. And you think that maybe it's receivables that I need to mention in this question. No. It has to be something related to the scenario. So from within the scenario, you go through the whole scenario and see what else would I need in order to make a better informed risk assessment. And that is exactly what needs to be looked at. So in this case, what the examiner says is that this type of question requires candidates to identify information that would be available in advance of the audit that would assist in the planning of the audit. Such information would generally help in the identification of evaluation of risk rather than the information available at the year end for performing audit procedures. Again, this is also a very important point that has been made by the examiner. In a planning question, in a strategy or a planning question, if it asks you for additional information, that additional information is not going to be vouchers or invoices or things that you would need at the final stage of the audit. Rather, it has to be something linked to the planning stage of the audit. So it could be minutes of meetings that have been held during there and already minuted. It could be events that have taken place so far and you need an update on that. It could be certain inquiries you want to make from the higher people, senior executive people in the organization. But it should not focus on areas that you are yet to touch. For example, the final audit procedures. You cannot ask for a confirmation of a bank balance when the year has not even ended. This is particularly relevant as the question was set almost a month prior to the year end. So financial statements and year-end balances would not yet be available. Now this is another important point that has been made here. So I will just try to recap some of the key exam techniques which we discovered earlier, and there are some more points that I would like to make that you could see on the board as well. So if we go back to the slide that we were talking about, so on the exam techniques with regard to risk questions, you can see on the slide. So you look for risk triggers, you prepare an answer plan, you prioritize and structure your answer. But also now there are certain other things that you need to look at. You consider your role. What is your role in the question? You consider the timeline. Where are you in the audit situation? Is it the audit acceptance stage? Is it the post-audit acceptance stage whereby you are starting to plan an audit? Is it the planning and strategy phase where you are actually at the client site obtaining certain information which you have and there is certain other information you still have to obtain and actually preparing an audit plan? Or is it the execution stage where you've actually done your planning and you're now performing certain procedures. So it's very important to consider the timeline very well. Then it's also important to consider the deliverable. Consider the deliverable. What is required? Is it an email? Is it a briefing note? Is it a is it a summary of the notes that the partner needs? Is it an email response? And what is required in that email? And then consider ancillary information, which is linked to additional information. So wherever you come up with additional information, do not throw the ball out of the park. Stay within the perimeters of the stadium. And that is what I'm trying to say is, from additional information point of view, consider related additional information or ancillary information, but not something that is outside the ambit of the question. So for example, if the company is making shoes, so you talk about shoes and inventory and all the issues related with inventory and what information you would need regarding that, but not regarding something that the company does not do or something that has not been mentioned in the question at all. So it should be related, it should be ancillary. Then, as I said over there on the slide as well, and you can see that always have an answer plan, always plan your answer, give a good professional answer. Your answer should be professional, the language that you should use. And then there are certain very important points to make with regard to precision, be precise, but also clarity. Also be clear. Detail does not necessarily mean too long. Writing in depth does not necessarily mean writing half a page for one risk. You can actually succinctly describe something really well in a very few words or very few sentences. Just 2 or 3 short sentences can do wonders for you. But sometimes you try to end up explaining in such a long detail that the whole crux of the risk is gone and it has not been described in sufficient detail. So those are some of the key things that I would like to mention and highlight again, in addition to what is there on the slides that you can see in front of you. And apply the so-what test to figure out what could actually go wrong and whether it has been stated. I highly recommend that you read through the ACCA suggested answer for this particular question. You do this in your free time. Set an alarm clock in front of you whenever you have the free time for this, and you mark your time according to answering this question. But now, do note that the 1.8 minutes per mark does not apply because you've already taken the 22 minutes out of this. So for the 35 mark question, if you're supposed to do this in, let's say, about 1 hour, you've come out with 22 minutes already spent. You've done the planning and you've done the reading. Now you do the execution part. So you'll figure out actually that half an hour, slightly more than half an hour, 37, 38 minutes, is actually more than enough to write an answer for this particular question. Why? The reason for this is that you already have a plan. So if I have given you a map to go to a certain place, it makes your life much easier. The reason for that is you know when you have to turn left and when you have to turn right. So always, I emphasize, always spend some time to plan. This time, initially it feels and looks as if it is a waste of time. You could spend this time writing. But actually, and it's a tried and tested approach, and you try doing it so that it actually proves itself to you. And when you spend a little bit of time planning, even if it's 3 minutes or 4 minutes, this will actually save time that you will be spending reading and rereading and then rereading the question scenario to identify more and more points. You will just read once, you make an answer plan, you've got the plan, you execute the plan, and trust me, there will be situations where you will be even left with 5 minutes and you will be done with everything. It's not going to happen overnight. It's not going to happen straight away. You will need a lot of practice. Some people have achieved this milestone at the 10th question one that they do. Some people have achieved this milestone at the 25th question that they do. But somehow, some way, you keep trying and doing it. It is doable. There are people, there are candidates, real human beings who've done this. There are candidates who've passed with flying colors, more than 75% marks many times. And the key thing that they say is that we did not write a lot of detail. We were clear, we were precise, but why was it? Because we planned. So the key message, the key takeaway from today, if there was one, has to be to plan for question 1. Always plan for question 1. If you have a good plan, you are more than likely than even 90%, I'd say, that you'd end up with a good structured answer. Do we have questions?
Not really. We can give people some time to write their questions in the chat box.
Sure. So we're done for the day, but if there's any particular question, you will obviously be given some time tomorrow as well if something comes up later in your mind. But if there's any urgent, immediate question that is popping up in your mind, we can stay here for another minute or two.
Cassie is asking a question that while drafting the answers related to risk-related question, do we need to describe the accounting standard in detail, or just a reference to the standard would work?
Just a reference to the standard would work. That is because this is not a B2 paper. So for example, if there is an accounting treatment with regard to IS, let's say 36, on impairment, you do not have to write the whole requirement of what is IS 36, what is fair value less cost to sell, what is the concept of impairment. No. It's just that there's an impairment trigger, it is triggering an impairment, and as per IS 36, there are 2 methods available, which we need to see which one has to be applied. So just give a small reference to the requirement of the standard, and then just move on towards the risk. Because bear in mind, the question is not about the requirement of IS 36. The question will always be about what is the risk with regard to impairment. So it is the impairment audit risk that is more important rather than the requirement of IS 36.
Perfect. Gurcharan is asking that if the risk is not significant, so do you recommend that we should mention that in the answer or just skip it?
I just talked on that slide about prioritizing. So you can see that this is the 4th bullet on the slide. So prioritize your risks. Some risks are more significant than others. For example, going concern will always be a very important risk. So it should be on top, but with a whole lot of reasons why that risk is going concern. But then there would be other risks as well, which you should explain because they also carry marks. However, it does not mean that you start writing about each and everything that comes into your mind in each and every risk. And this is good practice that when you do your answer planning, so when you are preparing the plan, there are a lot of things that you will be looking at. So you will be able to figure out that, okay, what I wrote at number 6 should actually come at number 2 because I think it's more important. It just occurred in my mind later. And this is the key thing that you would avoid if you are planning. If you don't plan, what you would do, you would write the first thing that comes to your mind, write a whole paragraph, then another one, and then by the time you reach the 3rd page, you figure out that the risk that you're writing is the most important risk. And actually the time is over. So that is an important thing to understand.
Burhan is just asking one question that do you recommend that in the end of the questions that they're answering, should they be writing the conclusion?
Oh yes, definitely. That's one point. Thanks for reminding me actually. Since I said that consider your role, consider your timeline, and then consider your deliverable. So the deliverable, if it's an email, obviously it has to end. So an email will usually end up with something like, if you need any further information, please feel free to contact, or the above or the summary of the key risks. If you would like to have further discussion, please feel free to give me a call or email, something like that. Best regards, XYZ auditor. So you should close this because you know the 4 professional marks that are available. At least I believe that half to 1 of that 4 would actually go to this part. So if you conclude well and you've done the whole risk assessment and you're closing the report down, I think it's a very good practice and you must do that. It's just like a free mark that's available actually. That you should grab that mark by doing a good closure.
There's one question from Asif, and he's saying that while drafting the answer to a question, if the question says describe audit risk and the other action verb is evaluate an audit risk, how should they structure the answer?
Okay, so on evaluation of the audit risk, obviously there is also some element of what procedure would have to be done to address that audit risk. So that would be more detailed because when you are evaluating something, it's like you're looking at the pros and cons of that particular thing. Evaluation is like a whole description around what the risk is, how it arises, how significant it is, and what needs to be done about it. Whereas description of a risk is only confined to the risk and not what needs to be done about it. So there's just a small, I'd say, one step further when it comes to evaluation of audit risk. So we are done for the day. Thank you very much, and we will see you tomorrow at the same time. Bye-bye.